process. So the first thing you have to do is close out all your temporary accounts. Okay, your revenues, your expenses, and your dividends have to be closed out. Next, your income statement accounts, well, how do you close them out? That's important. These are your income statement accounts. You close them to the income summary. All your income statement accounts get closed into income summary. Now, just again, bringing a little bit of a real world flavor into this. I'm going to make you in a few minutes do some closing entries. But I'm telling you that your accounting system will close these out and you will never make these journal entries. But it is still important that you understand what it's doing behind the scenes. Okay? So like, if you were to look at a retained earnings balance in a sophisticated accounting system and like click in to get the detail on that retained earnings balance, you're not going to see sales revenue, interest revenue, cost of goods sold, You're going to see one number. And why are you going to see that one number? Because you close it to income summary. And then that goes into the retained earnings.
Is this on Blackboard? All these notes?
The slides are posted on Blackboard. But there are some things that I've removed from the slides to encourage you to write and take notes. This is my new thing here. So I want people to write because I have noticed as the semesters go on, people just kind of sit there because they're like, oh, the slides are up on Blackboard. So they don't do anything. So I want you to write because I think it'll help you to learn. Okay? So listen, write, whatever works. Yes? Well, I posted them at like 1:30 this afternoon. That wasn't early enough? No? All right. Okay. All right. As long as I remember, if you don't see them up and you're looking for them the night before, just send me an email. Okay? I have 2 little kids, so I am running around with them, and all of a sudden it's the next day, It's like all of a sudden it's the next year, So that's my life. So I can surely do that. You have to if I haven't done it, just remind me. Like at 1 o'clock this afternoon, I went to do it, and then I was like, take it, and then I was like, did I even do it? I couldn't remember, and then I had to go back, So things just happen. So that's no problem. All right. So let's keep going. Next. So the balance and income summary should therefore be equal to what's in net income, right? That makes sense. If you're closing all those accounts out, the revenue and expense accounts, that should be equal to what your net income is. That goes into income summary ultimately. Dividends. Oh, income summary is closed to retained earnings, right? We understand that. Dividends close directly into retained earnings, not into income summary. And then, once you close all these temporary accounts, you have what's called a post-closing trial balance. What is missing? I know we talked about this last class, but that was already a week ago, so I'll ask you again. So what is missing from a post-closing trial balance? The income and expense accounts. It ends at retained earnings, right? Or other comprehensive income. It ends at the bottom of the balance sheet because you've closed all those accounts out into retained earnings. So it ends at the bottom of the equity, your trial balance. But it still balances because all the revenue and expense accounts have closed into them. So I have some journal entries here we would make. So when you close income summary, when you close your revenues and expenses into income summary, so expenses normally have what kind of balance, debit or credit? Debit. So when you close them out to 0, what do you have to do? Credit them, which means the other side of the entry is income summary. So income summary now has a debit balance, which represents the expenses. That makes sense, because that's where expenses normally have a debit balance. Revenues normally have what kind of balance? Credit balance. So to close them to 0, you have to debit them. Credit income summary. So now income summary has a big credit for revenues and a big debit for expenses. That would give you your net income or loss. Income summary closes out to retained earnings. This journal entry assumes that income summary is containing net income and not a loss. If it was a loss, then you would be, right, it would be reversed, exactly. That makes sense? Okay, so let's look at, I have exercise 314. Exercise 314. You're going to just make some entries. Exercise 314, you're going to close out some stuff to the income summary. So, going over this. So, you have to do, so just to be clear, when you close things out to the income summary, there's 3 journal entries that you'll have to make. One related to all the revenues, and these, and I understand that this is not something that you might intuitively know, right? These are not expenses, they're contra revenue accounts. It's like accounts receivable has an allowance for doubtful accounts. Those are contra to that specific account. So on a trial balance, your sales returns would probably be up with the revenue accounts, not with the expenses. Okay? So you have one entry for your, so if revenue has a credit balance, you have to debit it to bring it to 0. If sales discounts and sales returns, they actually have debit balances. They go in the opposite direction as the sales, right? If you have a sales return, you have to reduce your sales. That's what these accounts do. So they have debit balances, you have to credit them to bring them to 0. The balance, to balance that journal entry, you credit income summary for $319,000. So I would always start off with what you know. You know you have certain balances. You need to make them 0. So do the opposite to make them 0. What do you have left? That becomes what your balancing entry is, the income summary. On the other side, you have expenses which normally have a debit balance. So to credit, you have to credit them individually. This is where I want you to try to think about the real world here to make sense of this, okay? If you have accounts with a balance, you can't add them all up and then just make a credit to expense. Is that going to reduce any specific account down to 0? No. It's going to just do, I don't even know what you're going to, it's going to maybe in total make the expense, if you were to make an income statement, it would make your total expenses 0, but you'd have a lot of detail, and then you'd have some random credit, and then the balance would be 0. You need to make each of those individual account balances 0. Okay? So here is where we're doing that. We're taking each individual account balance and making it 0, and closing it to income summary. And now, you look at your 319 minus your 302. That gives you a credited income summary of 17,000. So to make income summary close out, you have to debit it now for 17,000 and put it into retained earnings. Yes?
When you doing this transaction, how can you put 302 there, even you don't know the whole number yet? How, you have the cost of goods sold and then the rest of the numbers down there?
Yeah, so you put in, so how I would start this off, I would start off not with this number. I would start off with the credits and add them up and see what they add up to, and then I would make the debit entry. So I understand what you're saying. You don't know it's 302. So great news flash, right? You have to debit and credit. Doesn't mean that you have to know the debit before the credit. It doesn't mean you have to know this is 319. You put in what you know, and then you have to balance. So to balance, this is what you do, okay? I'm glad you asked that, because these are the kinds of things you'll come across. A lot of times, as you become comfortable with accounting and you can make journal entries for everything and kind of understand what you're doing, you'll have many situations where you'll know you have to get to a certain spot and it requires you to put in what you know and then figure out what the balancing piece is. You know the right account, you just don't know the right amount. So next, what I'd like you guys to do, one more question? No, that's okay. Don't apologize. This is what, if you have a question, other people I'm sure have a question as well.
I'm a little confused where you got the 17,000.
Okay, so the 17,000. The 17,000. Here in income summary, is everyone seeing where the 319 comes from? It's just a balancing entry. So now, after this entry, income summary has a credit balance of $319. You've made a journal entry into that account for $319 credit. The next one, you've now made a debit entry into that account for $302. So if you were to make a T account with a credit of $319 and a debit of $302, what is your balancing entry? What is your balance? $17,000 credit. So the next thing you have to do is make that account zero. You have to now close that account. So to close an account that has a $17,000 credit, you have to debit it for $17,000. And so the balance goes into retained earnings. So this tells us we had net income of $17,000. Okay? So that's the thing. Journal entries tell a story. You can always tell, well, unless someone goes nuts and this, I mean, actually, a lot of times that happens, is journal entries are a story about what happened in your business. Okay? So the story here is, ultimately, the story here is that I had net income of $17,000. You can tell by these entries, if you were an experienced person going into a business and you see these entries, you would say, they must be doing a close. They must be closing out because I see they're using the income summary account. They must be doing a close, and I see that they have a net income of $17,000 for the period that they're closing. So that's a story that that's being told.
The first one is that I don't get it that much. Sales revenue and sales return allowance.
Okay, so sales revenue, what happens in businesses a lot of times, and I'm sure you've all been there, right? You go to Best Buy, you buy yourself, I don't know, an iPad or something. Don't they sell those now? You buy yourself an iPad, and then, you know, you're like, it doesn't do everything I wanted it to do. Or whatever, you're going to return it. Okay? So they recorded that. How much do iPads cost? Like $500 or something? What is it? 700? Oh man, you got a lot of memory in yours. So when you made that purchase at Best Buy, you know, they debited cash or credit card for the $500 or $700, right? And they booked the sales for $500. You go back and you return it. They don't debit sales. They might debit sales returns for $500, credit cash for $500. So now, then let's say they have a few other transactions. Let's just make one other transaction just to make something different. So also during the period, they make a sale for some television for another $1,000, okay? So they have sales for $1,000. So at the end of the period, rather than get into the T accounts, this would post to the ledger, right? So at the end of the period, sales has a $1,500 balance. Is that clear? Sales has a $1,500 balance. So on the trial balance, and cash has a $1,000 balance. These are just two excerpts from the trial balance, okay? So you have cash of $1,000. You have all your assets, your liabilities, your equity. Then you have sales of, what's your total sales we said? 1,500 total, right? Because you have some sale for 1,000 I made up, right? So this is your, put this up like a tiny bit. Oops, stop, wait. Oh my God. There's a stop button in the middle. I pushed everything but that button. Okay. So you have a debit here, you have your credits. So you have sales here, and then you have right below sales, you have sales returns with a $500 balance. Okay, these are again just excerpts, right? And then from down below, you may have expenses that come below. But sales returns, like normally accounts have numbers that are associated with them. So normally the assets are like the 100 accounts. The liabilities are like the 200 accounts. The equities are the 300 accounts. The revenues are the 400 accounts. Both of these are like, you know, this might be like account 402. If sales is 400, sales returns might be like account 402. I'm making that, I mean, you know, in every business it's different, but it's somewhat standard in that way that the account numbers have certain, go in this format, okay? They may be very long account numbers where they have lots of things that they mean, okay? I'm making this very simple. So here, so you have sales, credit and sales returns is a debit. So logically, forget anything we just did. What did you really make for the period? 1,000. You didn't make 1,500, you made 1,000. That was really what your revenue is. Okay? That's your net sales. That's exactly right. And that's what gets reported, your net sales. So net sales is made up of sales minus sales returns minus sales discounts and things of that nature. So here, if sales has a credit balance, what do you have to do with it to make it zero? You have to debit it. So we're debiting sales. If sales returns has a debit of 500, what do you have to do to make it zero? And that's what we're doing. That's all we're doing here. And then the balance goes to income summary. Does that make sense? Okay? Yes?
Okay, let's say if someone bought a TV and then it's a 30-day return policy and they return on the 31st day, but Best Buy takes the TV back and gives you a gift card instead, what would you write?
So they're taking the merchandise back. So they would have to put it back into inventory. I have to think about that. So if they return and they give you a gift card, well, cash is not impacted, right? It's really like a transfer of inventory. Because I'm making this very simple. Because really, when you return it, it goes back into inventory. Right. So they have right. So they're probably debiting inventory and crediting some liability. That's exactly right. See, you can walk through these things. That's a great thing about accounting. It makes a lot of sense. Nobody's out trying to trick you. Nobody's out trying to make things complicated. It's telling the story of a business. So that's right. You're debiting it back into inventory, and now you're crediting some liability that you have for in the future. Okay? Makes sense. All right. So let's look now. I want you to do a couple of other problems here. Just a little piece. I want you to look at a P32, letter B. Problem 3.2, letter B. I just want you to produce a very simple income statement, statement of retained earnings, and a balance sheet. Problem 3.2. So I guess I can put that up